I have spent my life around markets, and one of the oldest tricks in finance is to take a risk that has not been tested, wrap it in a smoother story, put a higher yield on top of it, and then watch intelligent people convince themselves they have discovered a better form of safety. That trick works for a while because most people do not buy risk the day it looks dangerous. They buy it after a long stretch of calm. They buy it after the defaults have been low, after the headlines have been kind, after the returns have looked steady, after a few giant institutions have attached their names to it, and after a generation of investors has started to confuse recent performance with permanent design. That is why I pay close attention when a market built on confidence suddenly starts arguing with itself about withdrawals, when the world's largest asset manager quietly says that redemptions in one of its flagship private credit funds will be limited. I do not hear a small administrative update. I hear a market being reminded what it actually owns. I hear wealthy investors discovering that the word fund can make an illiquid asset look more liquid than it is. I hear lenders, borrowers, and intermediaries all realizing at the same time that a good yield can be easy to buy on the way in and very hard to exit on the way out. And I hear something else that matters even more. I hear a warning that a great deal of ordinary business activity has been standing on top of extraordinary amounts of non-bank lending. That matters because private credit does not live in a glass box where only sophisticated investors can get hurt. It finances businesses. It finances payrolls. It finances inventory. It finances expansion plans that looked sensible when money was abundant. It finances the space between optimism and actual cash generation. If that money begins to retreat, the pain does not stay in a spreadsheet. It moves into hiring plans, investment plans, refinancing plans, supplier payments, and eventually the daily life of people who never once used the phrase private credit. The first thing to understand is that this market was not born as a cartoon villain. Like many things in finance, it began as a response to a real hole in the system. A company that did not want to sell stock and could not easily issue public bonds used to have a simpler path. It went to a bank, explained the business, pledged what it had, and negotiated a loan. That old world did not disappear overnight, but it did change beginning in the early 1980s. The number of individual commercial banks in America began a long decline. Today, there are less than a third as many as there were 4 decades ago. Even while the financial sector itself became much larger in absolute size and more central to the economy. People are often told that banking exists to gather deposits and channel them into productive lending for businesses. In theory, that remains a noble description. In practice, very large banks discovered that scale pays better when products are standardized. Mortgages can be scaled, credit cards can be scaled, personal loans can be scaled, auto loans can be scaled, broad, rigid lending products can be scaled. A bespoke loan to a complicated mid-sized company with an unusual capital structure is harder, slower, and less attractive inside a giant institution trained to industrialize finance. To be fair, regulation after the global financial crisis also made traditional banks more cautious about lending to companies without obvious collateral or simple balance sheets. So a gap opened. Businesses still needed money. Banks were less eager to provide flexible financing. And wherever a large and profitable gap appears in finance, someone eventually arrives to fill it. Private credit stepped into that gap at first. That was not crazy. There were good companies that genuinely needed capital. There were legitimate loans that the traditional banking system no longer wanted to write. There was real demand for flexibility, speed, private negotiation, and tailored terms. If the story had ended there, private credit might simply have become a useful niche. But finance rarely stops at useful. It moves toward scalable, then it moves toward fashionable, then it moves toward overfunded. That is when a sensible idea begins to change character. Private credit was helped by something else that was growing rapidly at the same time. Private equity had already become one of the defining machines of modern finance. A fund would raise investor capital, use it as a partial foundation, borrow more money, acquire companies, layer debt inside those companies, and then rely on future sales, refinancing, or operating cash flow to keep the whole arrangement moving. The important point is not the elegance of the structure. The important point is the dependence on debt. Debt supporting acquisition debt, operating companies supporting holding company expectations, investors supporting funds that support companies that support more borrowing. And when enough money is being made, or at least appears to be made, that structure attracts still more money. Private credit loved that world because private equity needed lenders willing to go where traditional banks had become selective. Private equity wanted flexibility. Private credit offered flexibility. Private equity wanted speed. Private credit offered speed. Private equity wanted lenders comfortable with complexity and leverage. Private credit was built to call complexity an opportunity. Then the feedback loop began. Private equity depended on debt to magnify returns. Private credit earned attractive yields by supplying that debt. Those attractive yields drew in more investor capital. More investor capital demanded more loans. More loans helped support more transactions. And the paper gains generated by the system made the system itself look more trustworthy. Nothing intoxicates finance like a rising asset base accompanied by stable reported returns. People stop asking what would happen under stress because stress is not visited in a while. That is how an industry becomes not merely large, but respectable. Then there was a third ingredient, unlike private equity, which still has to identify individual acquisitions and manage exits. Private credit could expand more easily by building relationships with pools of borrowers, with funds, and with companies that simply wanted money. In recent years, that lending also pushed into businesses building data centers, which added another layer of enthusiasm and another layer of potential bubble exposure. So the expansion of private credit was not random. Banks had grown more rigid. Private equity had grown more dependent on leverage. Institutional investors were hungry for yield. And private lenders had found a way to sit in the middle of all three. By the time many people noticed how large the market had become, it had already crossed into the trillions. That number matters. When risky credit is small, it can be absorbed. When risky credit becomes a major funding channel, it stops being a side. According to the source material you gave me, total debt outstanding in this risky class of finance had moved above $2 trillion, and broader estimates put the total private credit market around $3 trillion at the start of 2025. That is larger than the subprime mortgage lending figure that haunted 2007. Now, I want to be very precise here because precision matters in a fearful market. Bigger than subprime does not automatically mean identical to subprime. The structure is different. The banking system is better capitalized than it was in 2008. The economy is larger. The borrowers are different. But when a risky lending category grows enormous, is poorly understood by outsiders, relies on confidence, and begins to show signs of liquidity stress. I do not need it to be identical to 2008 to take it seriously. I only need it to be dangerous in its own way. A home loan bubble hurts households through housing. A private credit problem can hurt through business activity itself. Services, suppliers, staffing, inventory, expansion, refinancing. The reach is different. That does not make it safer. In some ways, it makes it harder to see. One reason investors were willing to believe in the safety of private credit was the way the returns were presented. The lending was never described as risk-free. In fact, the pricing itself made clear that risk was present. The average private credit loan for a smaller business with more than $50 million in EBITDA was quoted at about SOFR plus 500 to 550 basis points. With SOFR around 3.7%, that meant a basic loan was landing near 8.7 to 9.2%. That is not the pricing of a sleepy, harmless asset. That is the pricing of something that knows it needs compensation for uncertainty. The source also noted that this could be against businesses maintaining 60% equity as security. Put differently, the safer part of the market was still not especially safe. When people see a yield approaching 9% and tell themselves it is simply an upgraded bond substitute, I become interested. High yields do not float down from heaven. They come from risk, leverage, illiquidity, complexity, or some combination of all four. The danger in private credit was never that the industry did not know risk existed. The danger was that a long period of good conditions made people believe the risk had been tamed. That is a very different claim, and it is far more dangerous. At the start, private credit could choose good borrowers because it was serving a real shortage. The market needed flexible capital, the funds could be selective. But then money began pouring in faster than high-quality borrowers could absorb it. That changes the character of any lending market when capital grows faster than sound opportunities. Standards do not remain untouched. You can call it creativity, you can call it innovation, you can call it widening the funnel, but what it usually means is that yesterday's disciplined lender becomes tomorrow's rationalizer. The problem gets worse when the buyer of last resort begins to look suspiciously like the seller's cousin. Your source described how private equity firms, under stress and hungry for liquidity, increasingly sold companies to other private equity firms. I have always disliked circular financial motion that creates the appearance of validation without the substance of fresh underlying value. If property flippers keep selling houses to one another at rising prices, people can feel wealthy for quite a while. But the system is only as healthy as the next real buyer. In a chain of leveraged private transactions, one investor's mark can become another investor's assumption, and assumptions have a way of looking solid, right until they do not. That is how paper returns get promoted into an industry narrative. Then one day liquidity is needed for real. That is when narratives are forced to answer arithmetic. The BlackRock redemption limitation mattered for exactly that reason. If redemptions were heavily requested and only about 54% of them were granted, the market was being shown an uncomfortable truth. The assets may be priced periodically. They may be professionally managed. They may live in branded vehicles. But that does not make them cash. A business loan to a private borrower is not a treasury bill. It is not a money market fund. It is not a publicly traded share with a continuous bid. It is a promise tied to a company, a capital structure, a lender relationship, and a market environment that may be calm today and hostile tomorrow. When investors suddenly want out, the question is not what the statement says the asset is worth. The question is who will buy it, at what discount, and under what time pressure. That is why some people hear a story like this and say the real problem is dumb investors misunderstanding an illiquid product, and they are not entirely wrong. Illiquid assets should not be mistaken for instantly redeemable cash equivalents, but that explanation can also be too comfortable. If enough investors want out at the same time, and enough funds cannot honor those exits without strain, you are no longer looking at isolated confusion. You are looking at something that starts to resemble the modern logic of a run. No branch lines, no passbooks, no depositors in raincoats, but the same basic human impulse. I want my money before conditions get worse. That impulse is powerful because it does not require proof that disaster has arrived. It only requires suspicion that someone else may leave first. Once that begins, the very effort to secure liquidity can create the pressure that makes liquidity scarcer. This is where people often tell themselves that diversification will save the day. After all, a private credit fund is lending to many businesses. Not one that is true. And in ordinary times it matters. But correlation lives in the funding environment, not just in the list of borrowers. If many of those borrowers depend on refinancing and rates rise, their stress becomes more similar. If many are tied to private equity structures and private equity exits slow down, their stress becomes more similar. If many serve a weakening economy and customers pull back, their stress becomes more similar. Diversification works best when problems remain isolated. It works less well when the tide itself recedes and interest rates change the tide. A lot of people hear that private credit earns interest and assume higher rates must be good for lenders. That is a shallow view. Higher rates may raise nominal yields, but they also change the competitive landscape and the borrower's survival odds. If investors can get around 5% in a risk-free treasury, then a risky 9% private credit yield does not look nearly as irresistible as it did when cash paid almost nothing. The spread that once felt generous begins to look thin relative to the opacity and liquidity being assumed. At the same time, the borrower paying that floating rate is under real pressure. A loan tied to a base rate plus a risk premium automatically gets heavier as rates rise. The difference between paying $4 million of interest and $8 million of interest on the same basic debt burden can be the difference between endurance and distress. That is especially true when the borrower is already living inside a private equity structure layered with obligations above and below it. In other words, higher rates hurt private credit from both directions. They make the asset less compelling to investors relative to safe alternatives. And they make the borrower less capable of carrying the debt. That alone would be enough reason to worry. But the story becomes even more fragile when the lenders themselves are not purely unlevered pools of investor capital. Some of these funds also borrow in order to enhance returns by capturing the spread between their own funding costs and the rates they charge borrowers. That works beautifully when money is cheap, defaults are low, and exits are patient. It works much less beautifully when their funding costs rise, lending standards tighten, and the quality of their underlying loans begins to drift. Now the lender is not merely exposed to borrower weakness. It is also exposed to its own funding equation. That is how elegant yield stories become clumsy under pressure. Another piece people prefer not to look at is the connection back to the traditional banking system. Many investors like the phrase non-bank lending because it sounds as though the risk has been moved outside the core. I have never believed that renaming a problem is the same thing as isolating it. Your source pointed out that although the data is hard to aggregate because the deals are private, the Federal Reserve noted about $95 billion of lending commitments to private credit in the fourth quarter of 2024, a 12-fold increase over the decade before. Moody's analysis suggested bank exposure could be as high as $300 billion. That does not mean every dollar will burn. It does mean the wall between conventional finance and private credit is thinner than many people prefer to imagine. When banks finance private lenders, the word private stops offering much comfort. If the underlying assets stumble badly enough, the stress can travel. That is why the question is not only whether private credit can absorb losses. The question is where those losses would be felt, who would suddenly tighten terms, and how many financing channels would start retreating together. Then we come to the part that matters most to me. A credit system never fails in the abstract. It fails through the cash flows of real borrowers. The source you gave me emphasized that the final blow to private credit may come from the turbulence facing the mid-sized businesses it lends to. Job numbers had been revised downward for more than a year, and one recent month had shown a loss of 92,000 jobs. Those figures are not merely macro decoration. They tell you that businesses are getting less comfortable. And when businesses get less comfortable, the leveraged ones get less resilient. First, if demand weakens, revenues soften. If rates remain high, debt service stays painful. If costs rise because of tariffs or broader market turmoil, margins get pinched. If payroll becomes harder to support, layoffs arrive. And layoffs do not simply reflect a weaker economy. They can help create one. Fewer workers mean fewer customers. Fewer customers mean less revenue for the very businesses carrying expensive private debt. Less revenue means more defaults. More defaults mean tighter lending. Tighter lending means fewer rescues and harder refinancings. That is how feedback loops form. They do not require a single dramatic event. They only require enough strain in enough places at the same time. This is why I am less impressed by claims that private credit is safe, because the loans are negotiated carefully. A carefully negotiated loan can still become a bad experience if it was priced during a friendlier cycle than the one in which it must be repaid. Finance loves to forget that. Underwriting quality is not tested when everyone can refinance. It is tested when refinancing becomes selective. That is the moment when yesterday's confidence has to survive without the aid of abundant new money. And that is exactly the kind of moment this market is approaching. I am often asked what separates a nuisance from a systemic danger. There is no single line. But I have learned to watch for three things. First, I ask whether the asset or strategy depends on liquidity that may not be present under stress. Second, I ask whether the buyers of the product understand the conditions under which they cannot easily exit. Third, I ask whether the losses would remain inside a narrow circle of speculators or spread outward into financing for ordinary activity. Private credit worries me because it can fail those tests simultaneously. The assets are inherently illiquid. Many investors have treated them as if branding and scale had solved that. And the borrowing financed by this market reaches into ordinary business operations. Now, let me say something important. I am not predicting the exact date of a collapse, and I am not saying every private credit fund is doomed. Markets are not that simple. There are better managers and worse managers. There are better loans and worse loans. There are stronger borrowers and weaker borrowers. There are funds with more conservative structures and funds that have squeezed the lemon too hard. But when an industry grows this large, becomes this fashionable, relies this much on confidence, and begins to show withdrawal stress, while the real economy weakens, the right posture is not indifference. It is scrutiny. A great many financial disasters begin with the phrase, "This is not exactly the same as last time." That phrase is usually true. It is also usually useless. No crisis ever arrives wearing an identical coat. What matters is not whether private credit matches subprime mortgage lending detail for detail. What matters is that it shares certain dangerous family traits. It is large, it is complex, it is opaque, it depends on continued confidence, it touches leverage, it relies on refinancing, and when pressure rises, it reveals that liquidity was more conditional than many participants believed. Those are not minor similarities. Those are the bones of financial vulnerability. There is also a political problem embedded in all of this. Back in 2008, the government stepped into a system that was already terribly damaged, but the public balance sheet was in a different position than it is now. Today, debt is higher and inflation is already an active concern. So even if policymakers wanted to cushion a severe private credit event, the room to do so is morally and economically narrower. And unlike the housing bubble years, this debt did not even buy the illusion of prosperity for ordinary families on the way up. That is one of the bitterest aspects of the whole arrangement. The gains were concentrated in institutions, funds, managers, and the wealthy investors who could access these vehicles. The risks, if they broaden, will not stay there. That asymmetry is one more reason I dislike systems that depend too heavily on debt layered inside opacity. The upside gets privatized, the downside develops a habit of looking for a wider audience. If I sound severe, it is because I have seen how people behave when a financing machine has been too successful for too long. Success makes participants sloppy in ways they do not notice. Lenders start saying yes a little more often. Investors stop demanding as much compensation for illiquidity. Borrowers assume refinancing will remain available. Intermediaries point to past performance instead of future endurance. And every participant quietly shifts from asking, "What is the margin of safety?" to asking, "How much more can this carry before anyone objects?" That shift is subtle, then it becomes fatal. The deepest lesson here is not about one fund, one manager, or 1 week of ugly headlines. It is about the difference between yield and resilience. Yield is what people chase. Resilience is what they discover they needed. A 9% return can look wonderful until you realize it was sitting on top of assets you cannot sell, borrowers you cannot fully see, assumptions about refinancing that no longer hold, and a funding environment that has turned from generous to judgmental. I have never believed that a higher coupon by itself is evidence of superior investing. Sometimes it is evidence that the market is paying you to hold something other people will not want when conditions worsen. That may still be a fine bargain if the price is right and the structure is honest, but many people in private credit were not really buying honesty. They were buying the hope that scale, branding, and recent calm had transformed a difficult asset into a convenient one. That hope is now being examined. And once that examination begins, markets can move from confidence to caution much faster than most portfolio memos imagine. If I owned a business that depended on easy private refinancing, I would be asking harder questions right now. If I were an investor in a fund offering attractive yields from private loans, I would be studying the redemption terms, funding structure, borrower quality, and concentration with far more seriousness than whatever glossy slide deck first brought me in. If I were a banker extending commitments to private lenders, I would be thinking very carefully about what looked non-core last year and could become abruptly relevant this year. And if I were a policymaker, I would be paying attention even if the public still is not. Because one of the strangest features of financial trouble is that it often begins in a place most people consider too boring, too technical, or too niche to matter. Then a month later they discover it funded something they rely on. A lot of investors like to think that risk means volatility. That is not how I define it. Real risk is the possibility that a structure depends on conditions that will not exist when you most need them. Real risk is discovering that what looked liquid was only liquid as long as nobody was in a hurry. Real risk is building growth on refinancing rather than on durable economics. Real risk is trusting a chain of leverage because each link looked respectable on the way up. Private credit contains all of those possibilities. That does not guarantee an immediate disaster, but it does guarantee that the market deserves more respect than it was getting during the easy years. I have always said that when the tide goes out, you learn who has been swimming naked. In this case, I would modify that slightly. When money was cheap and exits were patient, many people mistook borrowed confidence for durable strength. Now the tide is not merely going out. It is revealing just how many structures were counting on calm, on refinancing, on patient investors, and on a banking system that was supposedly no longer involved. That is why a redemption gate in a giant credit fund is not just a technical footnote. It is a reminder the yield was never free, the liquidity was never guaranteed, the complexity was never conquered, and the real economy was never as insulated from this machinery as people wanted to believe. I hope the industry proves more resilient than its critics fear. I mean that sincerely. I never root for stress in a credit system because ordinary businesses and ordinary workers tend to pay the bill when financial architecture cracks. But hope is not analysis. And analysis, if it is honest, says that this market grew so large, so fast, and under such friendly assumptions that a period of strain was always going to tell us much more than a decade of easy money ever did. That period of strain has begun. The only question now is whether it remains a painful lesson for sophisticated investors or whether it becomes a broader lesson for an economy that has quietly allowed too much ordinary activity to depend on extraordinary amounts of opaque debt. When people ask me what I would trust in a period like this, my answer is not mysterious. I trust simple structures more than complicated ones. I trust cash flows more than stories. I trust liquidity that has been earned in the market more than liquidity implied by a quarterly statement. I trust borrowers that can live through tighter conditions more than borrowers that require ideal conditions to look healthy. And I trust margin of safety far more than I trust marketing language. That is why I would rather miss a fashionable yield than own a beautifully packaged surprise. In investing, you do not get paid for being impressed by financial engineering. You get paid for surviving it. And a great many people in private credit are about to find out that survival, not yield, was the thing they should have been underwriting all along.